Hello and welcome back. Our last lecture, we're going to look at foreign exchange market, and it's basically exchange rates, and we're going to look at the price of currencies. So let's look at exports and imports. So if you look at the first four, or you look at these four examples, you're going to know that in order to make these transactions, countries want to be paid in their own currency. Okay, and I know some places you can go and you can use U.S. dollars, and they don't care. I'm talking about business transactions here. Okay, large business transactions, they're going to want to be paid in their country's currency. Okay, so for all of these transactions, you're going to have to do that. The importer is going to have to exchange their currency for that of the exporters. Okay, so exchange rates. How do we figure out the exchange rates, or at least what each currency is worth? So let's examine the price of euros and dollars. So the price of $1 US in this example, if $2 gets you €1, right? $1 is $1 will get you 50 cents, right? And if we look at the price of the euro in the terms of the dollar, it is 2 over 1, which gives you $2, right? Which is what we just see there. That's one's easy, right? So what happens if you need more dollars to buy a euro? Right, so it goes from 2 to 1, so now it's 5 to 1. So we say the US dollar depreciates relative to the euro, right? It becomes weaker, okay? And I'm going to go through these slides quickly. I'm assuming that you'll pause them when you need to and write down what you need to, or at least take in what you need to. So I'm going to be going really fast, but you have the option to pause those, of course. And what happens if you need less dollars to buy €1? The price for a euro decreases, right? So it goes from 2 to 1 to now 1 to 4. Right, so the U.S. dollar appreciates, or we say it becomes stronger relative to the euro, or appreciates relative to the euro. So let's look at our foreign exchange shifters. I know you're like, shifters again? Why are there so many shifters? Well, we're looking at a supply and demand graph, right? If we're looking at U.S. dollars, there are people that demand dollars, and there are people, right? And then we supply those dollars. And who's demanding them? Well, not us, right? We have them, we supply them. Other people. Right, or other countries, I guess, say that. So let's use the US dollar and the British pound to look at this. So imagine a big market where you can buy all different currencies from every country, right? This is the foreign exchange market, right? So just like a product market, you can't take things without paying, right? So if you want Mexican pesos, you got to buy those Mexican pesos with US dollars. Okay, and so if you're supplying dollars and demanding pesos, well, if the peso is the thing being demanded, the value of that will go up. And if the dollar is the thing being supplied, the value of that is going to go down, right? So if you demand one currency, you must supply the other currency, or your currency. Okay, so here's our supply and demand. So we have a supply and demand for dollars and euros. Okay. So if at equilibrium, if it's just a 1-for-1, fine. But if Germans start to demand US dollars, right, we know that it's going to put upward pressure on the price for that, right? It's going to cost more euros to get that dollar, or that dollar will get you more euros, right? And so the dollar appreciates, and vice versa. The dollar would depreciate. So let's look at the shifters. The first one's going to be change in taste and preferences. I'll let you pause the video and kind of read these over because it kind of speaks for itself. Again, contact me if you have any questions over them. Here's the third and fourth shifter. And the fourth one is going to be the big one that we talk about, interest rates or investment opportunities, right? So we'll look at that in depth in a little bit, okay? But usually, higher interest rates, right? British people or anybody is really going to want to invest in the United States. And I'll just say it now. I guess I'll just let the rabbit out of the hat right now. Is the United States is a great place to invest. People like to invest in the United States, and that's why the U.S. dollar is one of the strongest currencies. Is because people invest here, and to invest here, you have to supply your currency to get dollars. And that's why the U.S. dollar is so strong. And we'll talk more a little bit later about, well, so the U.S. dollar is so strong. I don't understand why, why are we exporting so much or importing so much? I don't understand why this is occurring, right? I'll explain that, okay? Just give me a few minutes. So let's look at some practice. So for each of the following examples, identify what will happen to the value of the U.S. dollar and Japanese yen. Okay. And then what I want you to do after you look at these, I also want, how do these scenarios affect exports and imports? Okay. All right. Whoops, I gave you the answers there. Hold on. So pause the video and we'll look at these in just a second. Okay. Go ahead and pause it. Okay, here are the answers. You'll notice in scenarios 1, 2, and 6 will increase U.S. exports because U.S. products are now relatively cheaper. So, for example, number 1 and 2, the U.S. dollar depreciates, and 6, U.S. dollar appreciates, so supply falls and yen depreciates. This would increase U.S. exports, right? Because the Japanese are going to, right? Their currency is stronger, so they're going to be able to buy U.S. Goods, right? All right. How do interest rates affect currency appreciation or depreciation? All right. Let's imagine that the United States increases interest rates. It's not right now. It's terrible right now. The interest rates are very low. But let's not only just look at interest rates, let's just look at investment opportunities. So how would this affect? How does this affect the current account and capital account? Well, if other countries are investing in the United States, they're buying up stocks, right? Because the stock market's doing really well. They're investing in the technology companies because we have a lot of technology companies. They're buying bonds because the interest rate is relatively higher than their country, right? They are strengthening our dollar. Why? Because they're converting their currency. They're buying our dollars with their currency, and they're bidding up the price of a U.S. dollar for all currencies, right? And so the U.S. dollar becomes one of the stronger currencies. Now, what do you do if you're a country and your currency is really strong? Well, you go to the store and you're looking at goods and services, and you notice that the foreign goods seem cheaper relative to your own country's goods, right? Why? Because if you're only buying things from your own country, those things are expensive because you're using U.S. dollars. But if you're using U.S. dollars to buy your supplies and things like that from foreign countries, or you're just buying them straight out from foreign countries, it's going to lower your costs and your prices are going to be lower. And so foreign goods are relatively cheaper. And so what do Americans do? They buy those cheaper goods, they go home, done, right? And then the foreign countries take that income, they convert it into U.S. dollars, they buy stocks and invest in American companies and do all that. And the cycle just keeps continuing over and over again. So I tell people all the time, yes, we vote for president, we vote for senators, we vote for mayors and all that stuff, but we vote every day with our wallet. And we vote every day that we would prefer to have cheaper goods and services in our homes, our cars, our frying pans, our clothes, et cetera, right? And that's just the way it is. That's part of the trade, the balance of trade and the balance of payments, right? That doesn't seem to hurt us though, right? Why? Because most of that money comes back, right? A lot of your jobs are reliant upon foreign investment and things like that. So it's not that, maybe manufacturing jobs are decreasing, but we are becoming a service-oriented industry. Right, we're becoming an industry, engineers and accountants and financiers and banking and those types of things. We still do have huge manufacturing plants, right? But even those, you have to be almost an engineer to be an assembly line worker in some of those, right? We're very high tech. And so it's interesting, but and that's of course a discussion. It would be better to have in class, but I'm always willing to have it. You can contact me and we can discuss it if you'd like. There's a lot of things that go into it, a lot of benefits and a lot of costs, but that's a discussion I'm definitely willing to have with you. And that's it. So that's the last lecture. I guess I'll bid you adieu until next time.